Good afternoon and welcome to the Farmland LP Why Farmland, Why Now webinar. I'm Tom Sullivan, Managing Director, Capital Markets and Investor Relations. Thank you for taking the time to join us today, and we trust those of you on the East Coast are doing your best to stay cool. Today, our founder and managing partner, Craig Wishner, will provide an overview of farmland as an asset class and why we have been investing in farmland for over 15 years. He will also discuss some of the reasons behind why we believe now is an opportune time to invest in the farmland sector. We will reserve the last 10 to 15 minutes of the webinar today for your questions. To submit your question, click on the box at the bottom of the page, and we will do our best to address as many questions as possible today in this webinar. We will be recording the webinar, and a copy will be available to all attendees. So during our webinar today, we will be making some forward statements, and a PPM will be available for any interested investors. So Craig and I are just two members of our 11-person fund management team. Other senior members of the team include Mark Chetical, our CFO, who has been with us for 7 years and has an extensive background in real estate finance. In addition, there's my colleague, Michelle Ewert, who joined us recently on the IR team in January as a director. A key asset for Farmland LP is our 50-person farm management team. Leading that effort is Kevin Lehar, our general manager, who has over 30 years of experience in agriculture and agronomy. He is supported by a team of multi-generational farmers, including Frank Savage, our farm manager in Northern California, Rick Poot in Oregon, who is managing Riverwood Farm, a key Fund 3 asset, and Randy Grimm, our organic blueberry and permanent crop manager. This talented team of farmers executes on our strategy in the fields every day on behalf of our investors. I'm going to turn the mic over to Craig Wishner, our founder and managing partner, to walk you through why farmland and why now. Craig?
Great. Thanks everyone for joining us. Thrilled to have you here. We're excited because we have some new data for you and some slides that communicate concepts that we think make farmland really an interesting and exciting asset class. It's also very relevant. We eat every day, and I'm sure all of you enjoy high quality food, and understanding kind of where that comes from and that the economics that really drive that we think is interesting and fascinating. And it also makes for a wonderful investment, which we'll talk about with you here today. So to start, just for context, we've been doing this for 15 years. So my name is Craig Wishner. Started Farmland LP 15 years ago, got my start in commercial real estate actually since I was 3, running around with my parents, owning and managing apartment buildings, to my degree in biochemistry and molecular biology, the biology which we use for our healthy soil practices, to running companies and private equity before 15 years ago, switching full time into farmland and agriculture. And we really and so we've built this company to the point now where we're the 14th largest farm manager in the US, and the largest focused on organic and regenerative agriculture. We have around $300 million worth of farmland under management, over 18,000 acres now, and that 15 years, we actually have now proven that the value add practices that we employ really deliver value. So the headline is basically buying farmland that grows low value commodity crops, generating rents of $300 an acre. We've shown that you take that through a 3-year organic conversion process and then get rents of $750 an acre. And there's other ways that we add value too, through permanent crops, which we'll talk about as well. But it's a really nice, solid strategy. And the average farmer that we work with leases 1,000 acres from us. So it's a it's worked very well. As Tom said, we have an 11-person fund management team and a 50-person farm management team. A subset of those are focused on the farm management aspects, and a portion of those actually do direct farming for us. So we lease out 2/3 of our acres, and we happen to farm ourselves about 1/3 of the acres, organic blueberries, wine grapes, organic vegetables, and things like that. So with that, let's talk about farmland as as an asset class and why farmland. So you've probably seen farmland in the headlines, and you hear about Bill Gates investing in farmland. He has about 5% of his net worth in farmland, and it's a fair bit of money for him. But that $5 billion compares to a $3.8 trillion asset class. So he's really just kind of a rounding error in that. But there are a lot of institutional investors, billionaires, et cetera, wealth management firms that really have seen farmland as a great asset class to invest in because of its underlying financials. Farmland is a very large asset class as well. There's $3.8 trillion worth of farmland in the US. That's actually about the same as all of the apartment buildings in the US or all of the office buildings in the US. And about 40% of farmland is leased. So farmland is commercial real estate, just like those other asset classes. Few nice things about farmland: it's not correlated with the stock market. It also has very low leverage, whereas apartment buildings have over 50% leverage on the sector. Farmland only has 13% debt on the sector. And what that means is that if there are credit issues, you're not going to have a whole bunch of farmers running into credit issues being forced to sell their farmland and driving prices down. So it's a very stable asset class over time. The other interesting thing about it is that only 2% of farmland is institutionally owned. About $50 billion worth of farmland is institutionally owned. And that means that it's a less competitive marketplace. We can find wonderful farmland that is growing low-value commodity crops, buy it and execute a value-add strategy without having a bunch of competitors like you would have in apartment buildings or office buildings. And if you look at the financial returns over time, farmland really generates a nice high annualized rate of return at a very low standard deviation or volatility. So farmland's returns actually beat commercial real estate in terms of its total return and a lower volatility. Same with the S&P 500, for example. And if you see the growth of farmland on the right-hand side, you'll see the yellow line is farmland. It's the slow and steady wins the race. Commercial real estate is more leveraged. So you see a big dip in 2008, 2009. And you also see one kind of happening right now. And the S&P 500 definitely has periods of time with wonderful growth, but also has that really strong volatility, which actually makes it the hare in this tortoise of the hare scenario. To give you a sense of where these returns come from, basically farmland has delivered around 11% annualized returns over the past 85 years. Half of that from cash flow, half of that from appreciation. And here's just two charts showing how the average cropland acre has appreciated since 1993, and rents also steadily go up as well. An interesting thing about farmland as well is that it consistently beats inflation roughly by 6.2% per year over decades, really since 1970 when this data started. And if you think about it, what is inflation? Well, inflation is prices going up, and in particular, food is a core part of the inflation story. And when food prices go up, the value of the crops grown per acre goes up. So the farmers make more money, and the landowners who own that land also make more money because the crops generated per acre are going up. That's a key fundamental premise, is that the value of farmland is really driven by the value of the crops that grow on that land. And by investing in farmland, you're really investing in one of the most pure inflation protected asset classes around, and one that beats inflation over the decades. And at the same time, farmland is this great asset class. It's actually declining. All of the commercial real estate, when Amazon builds a new industrial warehouse, or D.R. Horton builds a new housing subdivision, or Walmart builds another Walmart, most of the time that's going on farmland. And so converting that farmland to other forms of commercial real estate or residential real estate, shrinking the supply of that. At the same time, the US population continues to grow, and it takes around 1 acre to feed one person. So these lines are converging over time, basically creating more scarcity over time. We'll come back to this point in a little bit. But these are some of the fundamental factors that are really kind of just driving why farmland. And now let's look at why now. What makes this timing on this durable asset class, what makes now pretty special? So from a macro standpoint, you all know that debt has increased for the 13% of farmers who do use debt. That is causing some significant issues with them. Some of the permanent crops are at low prices, like almonds, et cetera, which is putting pressure on some people as well. And farmers continue to get older and continue to need to exit, and their kids are really not coming back to the farm. At the same time, where there's potential supply issues, more farmland coming out of the market, the competition is actually getting lower. The lower prices and the debt is kind of restraining the smaller farmers from expanding their asset base. The existing agriculture funds is pretty unique. What's happening is that a lot of them raised a lot of capital 10 years ago, and now is the time where they need to monetize their portfolio. They're kind of forced to sell at that time period, and they need to close their funds before they go out and raise more capital. So we do see institutions on the market selling their farmland at this time. And at the same time, the lenders are really limiting the amount of capital that's going out a little bit because of the pricing. So what this basically means fundamentally is that more properties are on the market at attractive prices. So it's a good time to be buying. Another component is that just kind of a general truth about farming and farmland is that the large farms are more profitable than the small farms, and actually smaller farms have been decreasing. There's a little bit more consolidation in the sector, but it's typically the larger farms that have more debt as well. And so what we're seeing is really large purchases that are becoming available, which is pretty unique because they're typically more profitable. They don't come on the market much, and now we're seeing just some extra supply, which is quite meaningful. I wanted to give you some insight into some of the cycles that happen. Now, there's over 40 different crops that grow on our farmland. So that diversification, that crop diversification, is very important to us from a biological standpoint. It's also very important to us from an economic standpoint, because we know certain markets have a cyclical component to them. Some of them are very strongly growing, like the organic market or organic blueberries, but some have this historical cyclicality, and almonds are one that has this kind of strong cyclical component, and we put some data together to illustrate it for you. The first thing to look at and to understand is that the almond market has really grown consistently over the past 30 years. It's actually grown 8.1 times over the past 30 years, which is around 7.5% annual compound growth rate over time, which is pretty darn extraordinary. It's a great food. Most people who are listening probably eat almonds, so it's a very, very strong fundamental demand. But the interesting thing about permanent crops in general, and almonds, for example, is that once you plant them, it takes 7 years for them to reach kind of production, even 7 to 10 years to reach full production. And so when people see other farmers making a ton of money with almonds, well, they go out and they plant a whole bunch of almonds, and often what happens on a cyclical basis is that those trees, by the time they come into production, actually exceed the market demand at that point, and that causes the prices to go down. So that 7-year lag between seeing someone else is profitable, planting that in the ground, and getting that crop 7 years later is what causes this kind of over cyclicality. Once the price goes down, then the poor producers have to remove their almonds from the ground, et cetera. Or if they planted in areas that really shouldn't have been planted, like they don't have good water. So what you see is this cyclicality around 10 years, kind of peak to trough, or 10 years between peaks on this. And what we see, and so we have not invested in almonds for the past 10 years because we saw too much oversupply. But what we're seeing now is that the oversupply is being washed out. You see this decline in the oversupply and the supply up top. And also the pricing has really been driven down for a number of years, really driving out those marginal players. People who had debt associated with this are really being driven out. And in fact, we identified a $400 million portfolio, too much debt taken back by the lender. And we identified about 15% of that portfolio that was just ideal on their great soils, great water on that. And because of our ability to move quickly and the bankruptcy process that they were in, we were able to get those at less than 50 cents on the dollar. So, great farmland at really phenomenal prices on that. So that's an example of kind of understanding these cycles really makes sense. And now this will add more crops to our farmland and portfolio. A market that really is undergoing strong growth in general and has for the past actually 25 years. We've been doing this for 15, and it still continues to grow, is the organic market. So over $60 billion a year is spent on organic food. It's growing at double-digit rates. And in fact, Costco sells about 10% of the organic food in the US. Our understanding is the largest organic retailer of organic food. And their CEO says that they can't get enough organic supply to keep their shelves stocked day after day. But that says that that market would be larger if they were able to get that supply. And you can't have organic production without organic farmland. So the organic farmland is only growing at half of the market rate. It's basically chronically undersupplied. And that's exactly what we do is we buy farmland. We take it through that 3-year organic conversion process and then lease it out to farmers at this stepped up valuation from $300 an acre to $750 an acre. Another big factor, some of you are having heat waves right now. You know that the weather is being essentially unusually weird right now, but it is part of longer term trends. When we started investing 15 years ago, we identified that the climate threat was basically threatening certain regions due to heat and water issues would be harmed by these climate trends. And certain areas would actually stay the same or benefit from the climate trends. And so a very first screen for the kind of farmland that we buy as we're just buying in areas that will stay the same or benefit from the trends in climate. And so this map gives you kind of a little bit of an idea. The south and the central parts of the US are really on track to have some pretty severe issues, and the areas that we're investing will actually be very strong in the future. We talked about the normal farmland trends declining and population increasing. This will actually exacerbate that. The USDA on the right-hand side here, you see the quote, is expecting around a 30% decrease in agricultural yields due to temperature and moisture changes by 2050. That 2050 was actually based on old data. So that's actually happening and will continue to happen earlier than that. So not only is growing temperature a key factor here, but water is a fundamental input into agriculture. And the beautiful thing actually about water is that when you buy farmland, you're buying water right along with it. And so we talk about buying sunshine, dirt, and water. Sunshine is great growing climate. Dirt is high quality soils. And water, we're buying both the physical access to water as well as legal ownership of that water. And so that's essentially buying the water right. Water is, in the states that we're buying, is a property right. It's as secure as if you own a piece of land, you own the right to that water. And if you buy farmland, that was usually the first user of water. And so you're what's called the most senior and most secure water position there. Our water rights in California, for example, go back to the 1850s on that. The state doesn't have a priority until 1914 on that. The other nice thing about the properties that we already own and that we just went into contract on are that we basically get free water. It costs us around $12 per acre foot worth of water. 1 acre is the size of a football field. 1 acre foot worth of water is 1 foot deep water over a football field. It takes 3 to 4 acre feet worth of water to grow 1 crop, like 1 corn crop. So we actually have basically 4 acre feet worth of water on all the farmland that we're buying in this portfolio. In this purchase right now. And we're paying $13,000 an acre for it. The water costs us around $12 per acre just to pump it around. But if you look at this water index that's on the chart, so this is a publicly traded index, the Velez California Water Index, and you see that the price over the past over a decade has been at the lowest $200 an acre. And then during times of drought, it's gone up to over $1,200 per acre. Cities, which are really more of a recent phenomenon, they have junior water rights. They typically pay $1,000 to $1,500 per acre foot worth of water. So when they need water, they have to go out and buy it. And these are the kind of prices that they have. Well, we have basically 4 acre feet worth of water on these properties. And so in the future, when there are more water constraint issues, this represents really upside for us. And again, when we're buying farmland, we're buying the dirt. We often feel like we're getting the water for free on this. So those are some why now. Let's talk a little bit about our Fund 3. And so our fundamental strategy is number one, buying high quality farmland that has high quality soils that we can convert to higher value crops with strong senior water rights. And we're buying at least $50 million worth of farmland in one tight geographic region. We have 3 of these regions today: Northern California, Oregon, and Washington. Each one is very diversified in terms of its climate regions, in terms of the kind of crops that grow in each of those different areas. And that strategy really allows us to create great economies of scale within those areas. We're about 300 million today. Fund 3 will double that, and we're really not going to have to expand our on-the-ground farm management team. So we'll really get economies of scale basically as we double the land value in this fund and then continue over time. The second thing that we do is add value. So converting the land to organic, as I've talked about. We always use healthy soil biology practices that really deliver a lot of value: healthier plants, healthier crops, greater yields, higher quality fruit, which particularly, for example, when we're growing blueberries with Driscoll's, it's a very important value add for them. And we actively manage this farmland. So we have people on the ground in our own team. And fundamentally, we're basically looking to increase gross revenues per acre and also gross margin profits per acre as well on our farmland. So we consider ourselves a value add fund. If you're in commercial real estate, the risk profile is closer to core or core plus, but we are able to deliver value on that as well. While we're doing all this, we really deliver a lot of other value as well. Let me give you a couple examples of properties that we've already purchased in Fund 3. So the first acquisition that we did, around a $30 million purchase, very close to our Oregon farm management headquarters. So we have a nice footprint in Oregon. This was a nearby property. The seller basically, it was time for them to exit. And we were able to acquire that property at 10% below appraised value. And it was crops that we already had an expertise in, organic blueberries, wine grapes, hazelnuts. It was cash flow positive when we bought it, but we identified that there was a very good redevelopment opportunity. Basically, of this little over 1,000 acres, about 400 acres were old hazelnuts, and they really weren't generating any net cash flow at all. And so we identified that we could remove those old hazelnuts, replace them with organic blueberries and wine grapes as well, and really increase those returns. So with just an additional $8 million worth of capital development, we're able to take those returns. So we bought it at basically an 8% IRR if we did nothing to it. And by doing this $8 million worth of development, we'll get a 15% IRR on that property. So really happy about that. That property is already in the fund. And we just went into contract on 3 additional properties, as I was talking about. These are very close to our Fund 1 main 4,000 acre property. These are right exactly in the same area, same high quality soils, same great water rights, and planted primarily in almonds on there. And as we've talked about, we intentionally haven't invested in almonds for the past 15 years, but now basically being able to get them at half of the appraised value from just 6 months ago is a wonderful opportunity for us. We're basically buying it at bare dirt pricing and getting all the improvements that they put on for free. These properties are also just about to kind of ramp up to their normal full maturity on there. It's one of the reasons why the owners didn't have the cash flow to make it really over the next couple of years for strong profitability, and they had too much debt on it. So we're super thrilled with this acquisition. This is really an example of what we're doing right now, and these same dynamics are going to help us kind of fill out the rest of the $250 million fund. So on the one hand, we're very focused on delivering wonderful financial returns for the investors. By converting it to organic, by focusing on healthy soil biology, we also are delivering wonderful returns to the ecosystem, wonderful, basically benefits for the planet. This is an example, this is a summary actually of a report that we did with the USDA. They gave us a $250,000 grant to quantify the benefits of what we were doing, and had 2 independent firms actually do this analysis. And fundamentally, in summary, what it showed was that not only did we deliver a 70% net economic gain to our investors from this $50 million portfolio, but we also delivered a 46% gain to the ecosystem. And really through our farming practices, what it showed is that if that land had been farmed conventionally, it would have caused $8.6 million worth of harm to the ecosystem, soil carbon loss, water dirtying the water, dirtying the air, biodiversity loss, pollinator habitat loss. And the way that we managed it actually created $12.5 million worth of ecosystem service benefits. So really what we're delivering is a double bottom line benefit for the investors and for the ecosystem at the same time. In summary, our Fund 3, it's a $250 million offering size. We have structured it because of our size. We're able to structure it in a very beneficial way to investors. You don't have to worry about a K1. We have a corporate blocker in place that makes it easy for you to invest from an IRA or a 401k. Just get a 1099 div when we do cash distributions, not a K1. If you're a very large investor and you really want to do that, you can come in. Pretty much all the investors prefer the corporate blocker structure. Minimum accredited investor standard, 100K investment on a standalone basis. If you're going through an RIA or wealth manager, you can come in with as little as 50K. And from a fee standpoint, it's 1.75% management fee. It's a 10-year term. We're targeting net 2.5 to 3x cash on cash return over that period, about a 12 to 13% IRR. And our returns are very aligned with yours. So basically, first, we would pay a 6% annual preferred return to you. Then we return all of your capital, and only then do we split the proceeds, 80% to the investors, 20% to the GP. So we're really here to deliver returns for you. And so in summary, farmland, the demand for farmland and its agricultural products exceeds supply. The sector, we're losing farmland over time, which will actually just increase the returns. The performance of farmland has been very, very good over time. It's a wonderful inflation hedge, and we're delivering very positive impact as well. So with that, that's the quick overview. And now if you have any questions, we're glad to discuss it.
Yeah, Craig, there are a number of great questions out there. Let's do a lightning round on some of these. And again, if we don't get to your question on the webinar, we'll respond to you after. First question, maybe a basic one, but an important one. What's organic? What defines it? And what's the difference between organic and regenerative?
Great question. So organic is actually federal law. So the federal organic standards were put in place 25 years ago. It's managed by regulations under the USDA. The USDA licenses independent certifiers, licensed certifiers that go out and approve farms. We have to show that we have not used non-organic fertilizers or pesticides over the last 3 years on that. And then every year they come back, once we get certified organic, and verify that every year thereafter. They look at our purchase records, they look out at the fields, they look at the revenue sales, make sure that we're selling the appropriate things. So it's a wonderful, very really confidence-inspiring structure for that. Regenerative, there is absolutely no standard. When we talk about it, we talk about the healthy soil biology practices, focusing on mycorrhizal fungi and cover cropping and pollinator habitat and a whole bunch of other things which actually deliver a tremendous amount of value to you. And that's very important to us. There are others out there who are greenwashing that. And so it's a less favored term for us because it's non-specific. But the certified organic, you can have a lot of confidence in. It's basically like getting a financial audit. Regenerative is a very good thing, but you have to watch out for greenwashing.
Craig, a couple of questions came in on structure of returns and how we generate returns. Can we talk a little bit about, over that 10-year cycle, what returns will look like? Are they cash flow, appreciation, et cetera?
That's great. So normal average farmland over the past 85 years is about 11% annualized returns, unlevered half from cash flow, half from appreciation. We're a value add fund. It takes us 3 years to convert that land to organic, or 3 to 5 years to plant those permanent crops and have them start ramping up. Sometimes we're buying already cash flowing permanent crops like we did at Riverwood. But we're still doing some kind of value add and redevelopment on that usually. What we tell the investors is basically not to expect cash flow during the first 3 to 4 years. That's really going into that value add process. And then after that, the returns ramp up, especially on the permanent crops. And towards the second half of the fund, we're expecting to deliver basically the returns 2/3 cash flow, 1/3 appreciation on that.
Great, thanks. And I want to point out the person who asked that question asked if we've already captured all the low-hanging fruit. So we appreciate the pun. Next question, Craig, was really surrounds. The next question surrounds our selection process for farms. What does the pipeline look like, and what are the key determinants of our selection process when we buy a farm?
Great question. So we do a lot of screening. We look at a lot of properties. We recently hired a full-time acquisitions manager, but even before we hired him, for example, we screened, just as a management team and the farm team, we screened about $2 billion worth of farmland to buy that $130 million property. So we really do screen a lot of properties. First, we do a macro assessment, actually a global macro assessment, to identify where the best places are to buy farmland from all the different factors. Sunshine, dirt, and water are kind of the big summary ones: growing climate, high quality soils, and water, with that climate change lens on it as well. How's it going to be affected over the next 10, 20, 30 years or more on that? Once we've identified those areas, which we have in the areas that we are, then we dive deep. For example, we have a 6,000 acre property in Walla Walla, Washington. It took us 5 years after identifying that region to really find an ideal entry point into that geography. Now, once we own farmland in those areas, then we have an on-site farm manager. We have farming tenants on that land. We know all the neighbors. And for example, in California, which we've been for 13 years or so, this portfolio of farmland basically right next door, one of them actually literally right next door, when they come up, we already know the areas, we already know the opportunities, we know the price and the value of that, and then we're able to move very, very quickly on the acquisitions side as well. So, and we do full financial modeling and analysis, and we know the pricing trends from appraisals and market sales and all that stuff, and crop dynamics. So there's a lot that goes into it, but after 15 years, we really have a lot of deep expertise. We do expect to add one additional geography kind of per fund, this $50 million geographies over time as we add additional funds, but really we can get a lot of expansion, a lot of economies of scale in our existing geographies without really adding much headcount.
Question, Craig, around how we set our NAV. When is that done? Investors come in at different times. Just the financial structure around valuation.
Great. So every year, all of our funds get a GAAP financial audit. So Moss Adams is our auditor. They're a very well-respected audit firm. And every year, we get each of the properties appraised by third-party professional agricultural appraisers, often selected by banks. And we actually have the auditors combine the GAAP audited financials, which are done at cost, with the market values from the appraisals, and that comes up with the NAV. So it's very third-party and arm's length. And what was the second part of the question, Tom?
Just when people come in at different times, do they come in how do they recognize the value of the assets already in the portfolio?
Great. So for Fund 3 and beyond, what we're doing is basically having a very short fundraising period. So we're raising the capital over a maximum kind of 12 to 18 month process. We're buying the farmland during that time as well, so we can acquire all that farmland, and then we're taking it through the value add process. So really, everyone's basically coming in at the same price. We are and we will start with a 6% essentially interest payment to investors who come in kind of in the second half of that fundraising period. So that's how we adjust for that within that fundraising period. Sometimes there are investors in our earlier funds that want to exit. And for example, our first fund actually has a 6-year lockup with twice yearly redemptions for the investors. It's been going on about 15 years, and about 85% of the investors are still in the fund. They really like the long-term nature of the asset class and how we're managing things. But if investors do have to get out, then they exit at that gap audited financial plus appraised value arm's length basis. And we just facilitate a new investor coming in, old investor going out at that arm's length market value.
Craig, a couple of last questions here. First one being, there's been a lot of events over the past 4 or 5 years or longer, wildfires in the U.S., in the Western U.S., et cetera. How have these risks changed our expectations on our portfolio? Has it impacted any of our farms? And what do we do to manage that risk of things like wildfire or others?
That's great. So the first thing to understand is that our farmland is usually very far away from the timberland or the forest land. So there were fires up in Oregon, for example, that were 50 miles away and across 2 rivers from us. And the homes that burned down, for example, are usually on that land timber junction, that intersection between those two. Our farmland generally is flat and not kind of in that forest area. So there's less issues from that. A few years ago, there was a lot of smoke, a lot of fires basically in Oregon. That created some smoke in the Willamette Valley. So we grow about 40 different crops on our land, including 3 varieties of grapes. Only the red variety of grape, Pinot Noir, and only part of that harvest was impacted by what's called smoke taint on that. And we got crop insurance for that. So there are, potential issues that come up. They're actually pretty small. And actually the crop insurance programs that we have in the US are actually pretty amazing and more than compensate us for that.
Question, Craig, on why we made this a 10-year fund versus an evergreen fund, and what's our expectations at the end of the 10 years?
Great question. So we made it a 10-year fund because that's what people are most familiar with, to be clear. But secondly, because we're a value add fund, that means that, if we just take farmland through that 3-year organic conversion process, we want to bring investors into a portfolio of farmland. So raise the capital, buy the farmland, and then take it through that value add process. So all the investors are going through that 3-year conversion period and then benefit from that organic conversion and the permanent crops on that over time, kind of as one group, as one vintage on there. And then the next year, 18 months later, do another fund on that, and basically continue that process. What we are looking at for an evergreen fund is after we get about $300 million worth of farmland that's already generating these premium cash flows. So if we're generating 10% net cash flow to the asset, but the market is happy with an asset that would deliver a 5% cash yield, we intend to create a cash flowing organic farmland REIT to be able to roll these assets into. Investors can choose to cash out at the rollover or stay in and continue to get the cash flow. without having any taxable implications from capital gains, and benefit from that long term. And going from that 10% yield to a 5% yield, that would basically allow investors to exit at twice the liquidation value of the underlying farmland, which would be beneficial for them. So that's the long-term plan. We don't have that today, probably 3 to 5 years from now, but that's the longer-term plan.
And we had a clarifying point on the questions around the preferred return. The 6% preferred return in Fund 3 does start the day you invest, and it does run the entire 10 years. So either that return is paid to you in a distribution in cash, or it will accrue, and that's the first priority on an exit. So the 6% starts the day you invest, and it does run the full 10-year process of the fund, term of the fund. Craig, maybe the last question, and I know there's more, and we will respond to others here via email or welcome a conversation. But just as we think about Fund 3 with the acquisitions we have to date, what's next for Fund 3? How many acres do we expect that to ultimately have? And where will we be going with our acquisition strategy on Fund 3 in the future?
Great question. So we see a lot of opportunity actually in Washington State, for example. Also opportunity in Oregon. There's some pretty unique opportunities. We executed what we wanted to in California for now. We think that's a nice little allocation for the $250 million to $500 million fund. And really the rest of a lot of the pipeline that we're looking at right now is, for example, cherries, apples, pears, another great annual cropland up in the Washington State region. We think that has really tremendous climate trends, wonderful water, great value add crop or value add permanent crop capability for that region, and great pricing as well. So that's where we see kind of a lot of the pipeline coming. This California property is really just very much kind of an opportunistic one that we just couldn't pass up.
And our last question, since we have 1 minute here, the question came up, are we at all related to publicly traded farmland partners? The answer to that is definitely no. Yeah, but the question came up, Craig, if an investor is thinking about a public vehicle versus our vehicle, what are the differences and what are the benefits of our fund versus a publicly traded vehicle?
Great. So the publicly traded REITs basically don't do value add. So they'll buy a property and they'll lease it right back to the owner on that. So really more of kind of a rental model. We're very focused on, and those properties can be scattered everywhere. We're very much focused on adding value to our investors and increasing that cash flow. The public vehicles as well, you have to watch for, is the market over or undervaluing the assets? There have been times when we've seen the public farmland vehicles trading at twice the liquidation value of the farmland, and it's come back down. So you have to be careful about entry price. You also have to be careful about leverage as well on those funds. Typically, they have more leverage, and the last point is that one of those vehicles, we're not happy with the kind of transactions that they've done that have favored management versus the common stock investors. So there is an opportunity. So some of them are better managed than others. The one that we like more is Gladstone Land is a better one. And if you're going to do due diligence and look at timing on that, that's the one that we would look at. But again, it's still really that passive farmland fund.
Again, great set of questions. We really appreciate those from everybody on the webinar today. We will be reaching out to you to respond directly to the ones we did not address. Greg, I'll turn it over to you for last comments.
Just thank you all for joining and being interested in farmland. Hopefully we've answered your questions. It's a really fun asset class. We actually just had our investor day out at our organic blueberry farm. Driscoll's came out, and we had about 100 investors out there picking blueberries with their families, and It was a great time. We have another one coming up regarding around wine harvest in September. If you have any questions at all, Tom and his team are just absolutely wonderful and glad to answer any questions that you have.
Thank you, everybody, for participating in the webinar today.
Thank you.
Thank you.